let's begin. So, first of all, thank you very much, everyone, for coming. This is a webinar on price action trading. And I want to thank you all very much for coming. First off, is there anybody that's new here? This is your first time at the price action class. Please let me know. And second of all, how's everybody doing today? Chuck says new. Fantastic. Welcome, Chuck. Menno says new as well. Okay, welcome as well. I'm just scanning through the names myself. Definitely see some new ones. Only 2 new? No, really? Seems like there's more. Maybe you're all just being shy. Okay, well, with that being said, Paul's J. Okay, great. Donkey as well. Fantastic. Well, first off, all new people, thank you all for coming. And for those of you who've been coming for the last several weeks, thank you for coming back. It's, as you continually come back again and again and again, you tend to improve on something. It's very important that, when learning trading, that you keep at it and you're diligent in your process of learning, you're diligent in the process of studying, and you're diligent in your process of practicing. I'm going through the same thing. I've been studying archery for a long time now. I've been practicing archery for a long time, and, I have to be diligent in it. Otherwise, I definitely lose a little bit of an edge. And as I'm diligent in it, everything just continues to get better and better. My scores continue to get better and better. I can shoot farther and farther distances with almost the same accuracy. Because trading is very much like archery. You're just repeating kind of a similar set of motions again and again and again. The only difference in trading is that the targets are moving. But other than that, shooting the bow is still shooting the bow. And finding trading opportunities is just finding trading opportunities. You're just repeating those again and again. So keep coming back, keep practicing. You will improve, and as you improve, you will see a difference in your trading. So this class is solely focused on trading price action. Very, very similar to, or not very similar to, but the focus is really on understanding price action as it is live. In the sense of, hey, what is the price action communicating in the real time? We are always trading the right side of the chart. We're not trading the left side of the chart. The left side of the chart is information, and we are simply detectives trying to find what the most likely conclusion is to this scenario. Is it up? Is it down? Is it something that's not interesting to us? That's what we're doing as trading. And the left side of the chart is just history. It's just information. And the only candle that is really live is the current candle. More often than not, I don't recommend trading live candles. I always recommend trading candles that are closed, because once it's closed, it's officially closed. It's like that forever. This candle will always be, once it's closed, that candle will always have that structure. There's nothing I can do to change that. And so that gives us something, it communicates something very clear to us, or it can communicate something very clear to us as to what was involved in that candle, what kind of order flow had created that candle. We don't have access to order flow, but the bottom line is that order flow, the total summation of buy and sell orders, and the total volume behind that, that's what moves the market. The whys, there are a million whys, completely irrelevant. Your job as a trader is not to really figure out the whys. Why did the market buy here? Why did it do this and this and that? You can do that, but there's so many whys. Rarely ever are you going to hit the bullseye in terms of the whys. You can spend your whole lifetime trying to come up with whys, In fact, if you want to, you can just become an analyst, which tries to predict the whys and then also talk about future whys as to why the market will move. But we're traders. Your job is to make trading decisions based on all the information you have on the left side of the chart, and then say, hey, is there a setup here? Is there a trading opportunity here? Does this create or activate a trade from my system? If so, if you have a trading system, and I hope you do, and I'm not talking about an algorithm which, you plug in M to MT4 and then it just does buy and sell orders for you. I'm not talking about that. That's a black box. I'm talking about a set of rules, a clear set of rules that are predefined, that when those rules are fit and they're all hit, that you execute a trade. That's what I'm talking about. A system which tells you when to buy and sell. And it could be automatic, but it doesn't have to be. It could be an algorithm that you just plug into a thing, but it doesn't have to be. I have, for example, a formation called an I-bar formation, and there are a clear set of rules for me to trade that. And when those rules are in play, I trade it, and that's it. Your job as a trader is not to think if the rules are active. Your job is to just make the trade, swing the golf club, hit the ball, and then once the ball's off the tee, there's not much, you can do about it. Wherever it lands, it lands. So with that being said, that's what we do as traders. We're not here to come up with the why. We're here to trade the market as it has presented itself to us in the past and as it is presenting itself to us now in real time. Now, I want to go over this one trade that one of my traders just recently took. He's long on the sterling dollar. He's been long twice on the sterling dollar in the last few days, and he's making money on it. And this discussion that we're going to have today about how important it is to understand price action, particularly in real time, kind of has a history to it in the sense of recently we had somebody come on the class. I can't remember his name. Maybe some of you remember it. But he was a fan of another form of trading, another perspective on the market. And I think it's an interesting perspective on the market. I think it has some value. But the bottom line is he was of the perspective that understanding support and resistance zones was the most important thing in terms of trading. That was the most important perspective to him. And I said, my thoughts on it were, well, that's useful. I think it's a useful perspective, and I think it's a skill. Exactly, supply and demand. And I think it's a skill that's worth learning. But do I think it's something that I would make the central core or the core of the ideology of my trading? And I would say no. And here's why. He was saying, well, as long as you can read supply and demand zones, you can make good trades. And I understand the thinking behind this. That one of the toughest mysteries for traders, and this is something you've all probably experienced, I experienced in the past, was entries and exits. Some of the most common questions I get from traders constantly is entries and exits. Where do I get in and where do I get out? Sometimes the question I get is, I can find a good entry, but I don't know where to take profit or when to take profit. That has to do with the exit. In reality, as a trader, most of your work is centered around entries and exits. And in some sense, being able to identify supply and demand zones solves one part of that mystery, solves the entry. And if you believe that if you get in at a support or resistance zone or supply and demand zone, that it's automatically going to go to another supply and demand zone before it does that, before it stops and turns around, well, that would be a nice reality if it was just as simple as that. And it would solve the exit thing. But sometimes the market just doesn't do that. You know, take a look at silver. It was making recently new all-time highs. How would you know where it was going to turn around? You might say, oh, well, there's a supply zone or a demand zone. But the bottom line is, when it's making new highs, none of those are there in the past for you to look at. So you're kind of blind. You have no history to work on, or no history that actually is relevant to your real-time trade. However, we always have the most recent price action. We always have the real-time price action. Those are things that are always available to us and that can always communicate information to us. And I want to give a really good example of how supply and demand zones or support and resistance zones were completely irrelevant to my clients, this particular client of mine, student of mine, making trading decisions. He just made these trading decisions based on this formation, and that was it. That was all he did. Didn't even care about supply and demand zone. Didn't mean anything to him. And he made money. So I want to go over it recently, the two trades that he had. He got in at 2 points, and I'm going to mark the lines, and we'll go over them. Two trades he bought, 63, what was it, 63.25, I believe it was, or 63, yeah, 63.25. No, sorry, 35, my apologies. Looking over my notes. So 1 pip below this line here. There we go. And then 62.60. So he bought at 62.60 and 63.34. And if you were a supply and demand zone or support and resistance zone trader, you would have thought, wow, this is easy. Why would I buy here? Why would I buy here? And why would I buy here? We're coming into resistance zones, supply and demand zones. Kind of silly. There's some previous support or resistance here. In fact, buying right here might be kind of silly because we're going into this huge zone of resistance here. And the same thing here. We're right at the tail edge of it. Why would he buy here? Why would he not buy on the breakout of this? And I'm not going to give you the exact details of the system he used. In terms of why he did that, because it's a proprietary system and he's paid for that. He's paid his dues to get that information. But I will give you some of the information as to why he bought it, other than the system itself. So first of all, take a look at this. Let's just take a look at, and remember, we have to trade the right side of the chart. This is where he was, right here. I'll highlight it for you. Bloody hell. Okay, this was his right side of the chart when he placed his buy order right here. And this is what he had to work with. And besides the formation coming up, this is what he had to work with. And I'll go through some of the things that we talked about. One, the market sold off from about 63.5 to just sub 60. 350 pips. It did it in a relatively, from this last move down, it did it in a relatively forceful fashion, relatively impulsive. It had a triple bottom here. So it had a triple bottom, which suggested that this thing was done selling off. But then what happened is this. Regardless of the triple bottom here, look what happens here. It all of a sudden starts to get really strong here. It has 4 candles of straight buying. 16 hours of straight buying. It breaks above the 20 MA, and then it shows you a lot of wicks to the downside here. This is all the chart that he has to work with. As it starts to have all these wicks to the downsides, suggesting that as the market dips down, many people are willing to buy it and scoop it back up. They're not accepting these prices. They're buying it and rejecting and pushing it back up. It then finds a 20 EMA support and then starts another 3-candle run. So he's looking at this saying, well, wait a minute. This thing had a 350 pip sell-off, roughly. It stops 3 times at almost the exact same level, and then it starts a massive run from here to here. Now, he didn't get the long off of this. He didn't get the bottom here. And like many people, like many of you traders, maybe he didn't get the beginning of the trade. The very beginning of a reversal is one of the hardest areas to get. The 2 toughest parts of a trending move that are the hardest for most traders to get is the first 10% and the last 10%. So you know what? Since those are the hardest parts, until you've really built up a lot of skill identifying them, try and get the 80% in between. That's your job as a trader. Try and get the most of it. And if those are the hardest parts, well then fine. Let's go for the parts that we can consistently and easily get. Who cares how we make money? As long as we consistently do it and we do it in a way mathematically that is set up for us to continually gain. That's our job as traders. Our job as traders is to make money and to do it in a fashion where we're constantly mitigating risk and we're constantly and mathematically putting ourselves in situations that tend to lead to outcomes of us continually being profitable. How we do it is really irrelevant. But the bottom line is this. Here we're in this trade, and he's looking at it and saying, you know what, I didn't get in on the bottom of this, but I'm presented with a trade opportunity on this candle right here. And so he's looking at it as, wait a minute, from 160 to 162.50, we've had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 candles. 12 candles. These are 4-hour candles. Only 3 of them, were red. And out of the 3, only one of them was some decent selling. Only one. So 12 candles, 1, 2, 3, 6, 9, 12. Is that 12? Let me see. 3, 6, 9. 12 candles. 9 out of 12 are being bought. From a perspective in time, 36 out of 48 hours, this thing was being bought up. Forget the pure structure of it. The pure time involved in it, 36 out of 48 hours, communicates to me that the order flow environment behind this was severely to the long side. It would be pretty hard for the market to buy this up 36 out of 48 hours without being more skewed to the long side than the short side. It would just be very, very difficult to create that. But then on top of it, we have additional elements. The blue candles are big and getting bigger, especially off the bottom, suggesting that there was an increase of buying pressure as it found support this last time. It was bought up, then there was more buying pressure, then there was more buying pressure. Then after running into a little bit of resistance around here, look what happened. It started buying again in aggressive amounts. The blue candles are constantly outweighing the red, both in size and in number. So this all communicates to me, as it did to my student, that there was a buying opportunity. This little formation came up, and many of you would probably say, whoa, this is a doji. This means indecision. That's one definition of it. I think it's a common mistake, and I think people have kind of gotten married to the idea that the doji is really the only interpretation, or that the interpretation of this candle being a doji is that it's indecision in the market. That's one interpretation. And I think too many people have gotten married to that meaning, oh, what's a doji, so it means indecision. The thing about it is that I don't think that's the only interpretation. I can take it in another direction. Let's take a look at it like this. Market's been bought up 9 out of 12 candles, 36 out of 48 hours. Maybe there is just a little bit of profit taking here. Maybe, I'm not sure what day this was, maybe this is a Monday morning. And it is, because we have the 18th and 20th here, there's a gap in the dates. So we're going from Friday to Sunday. So this candle really is just saying, hey, you know what? Not much order flow and liquidity. Why does it have to mean indecision? Why does it have to mean potential reversal? Not all dojis mean reversals. Again, that's just one interpretation of it. The bottom line is the market's been climbing for quite a long time. And then it has this little candle here where the market opens, goes up a little bit, goes down a little bit, and closes. It just means there wasn't much activity. That doesn't mean there was indecision. It just means for that day, that Sunday, not much was going on in the market. Why does that have to mean indecision? Why is that the only definition of it? Or the only interpretation of it? My interpretation of this is, hey, guess what? We've been climbing for a while now, 250 plus pips. And we've been bought 9 out of 12 times. To me, the information is still to the long side. I haven't seen anything in here that's communicating reversal. Why would this one little candle communicate reversal to me? I am seeing a little bit of the elements right here. Well, there's a decent rejection here. It's true. And if we break down this candle as a whole, it opened at 61.85. It dropped 4 pips and then climbed up from 81 to 55, roughly 74 pips. So to me, what does that communicate? Well, in the beginning, the thing opened up. The buying pressure was still in play. Why? Because the thing only dropped 4 pips from the open and then proceeded to advance 74 pips over the next few hours. So to me, that tells me the buying pressure that was previous in the last 2 candles, and maybe all the way from 160, is still in play. Because there wasn't enough selling pressure in there to move it more than 4 pips from the open. So the thing then climbs 74 pips, and then it closes at 62.22. It closes roughly 40 pips from the open. And of the entire candle, more of the candle is body than it is rejection. The candle itself, the body itself, is larger than the actual rejection. The rejection is something to take note of. But in this case, the candle, or the wick itself, isn't larger than the actual body itself. So that tells me, hey, there was a little bit of pushback, but it wasn't massive enough to say, hey, guess what? I should really be super concerned about this. When would I be concerned? When the wick clearly outweighs the body, and the entire price section of the candle is a large candle. If it's a large candle, that means there was a lot of order flow involved in it. If it started off just like this, opened, only dipped 4 pips, then climbed 70 or 100 or 150 pips, then I would say, wow, there was a lot of order flow on the buy side to create that type of candle. But then if at the end of the candle it closed and lost most of that ground that it gained, then I would be really, really concerned. Because to create just a candle that gains 74 pips in 4 hours, or 100 or 150, and then to give most of that back means that there was another side of the order flow on the sell side that was able to overwhelm the current momentum and buying pressure that's in play. But this didn't happen. This didn't happen at all. What did happen was it had a little bit of a pushback, and then that did create on Sunday a little bit of a doji, but that's understandable. Not much order flow on the Sunday when the market opens. He had a buy signal here, 62.60. This was his first of 2 buy signals. He bought it. And look what happened. At this point in time, this was his right side of the chart. Look what happened. The market only dips a little bit more, but not even it doesn't even dip more, it doesn't even get to the 50% mark of the entire body. Barely. I mean, maybe it does. Maybe it does to the but it doesn't even take out 50% of the gains from this open to close. These 2 candles, it's had 8 hours of selling pressure, and it hasn't amounted to much. 1 candle's gains are still twice as strong as 2 candles selling pressure. To me, the buying pressure is still in play. And then look what happens. Big candle, 4 hours of gains completely overwhelms the last 8 hours of selling, and then now the market breaks out of this previous high, and he's now long. He's long on the market at 62.60. So now he's created a buy order. Now, I can't tell you where he got out exactly, because that would be giving away some of the information, but it was a quantitative number. He had a fixed target, because we have done quantitative studies that when certain price action formations happen, that the likely result of this next target is going to be X amount of pips. It's not hard to find this information. It's not hard to do. With some good insight into the market, if you're able to ask the right questions and you have a really good programmer, you can find this information. However, to ask the right questions takes experience. So he bought it long, and look what happened to it right after that. Climbed for 1, 2, 3, 4 candles in a row, and then it finally started to pause a little bit. At this point, he's already taken his first profit and brought his stop to break even. Then what happens again? Market has almost the exact same formation as it did here. Decent gains, strong gains, then 2 hours of relatively paltry selling. Selling is not really coming in massive amounts. However, we have to say, hey, wait a minute. We're coming into a resistance zone here. If I was a supply and demand trader looking at supply and demand zones, my only real trade opportunity here would be, hey, I need to take a look at the short side. We're coming into a massive resistance level here that has rejected the market 3 times before. If I was a trader of history, I would probably be willing to put my orders on the sell side here than the buy side. It's a good opportunity. Sell it here, tight stop above. It's a great opportunity. I understand the thinking behind that. But this is my point and why it's important to understand price action. Because in real time, from here to here, what do we see? Actually, from here to here, what do we see? Following a triple bottom from here all the way up to here, and now he has to make another decision. From here to here, how many candles blue and how many are red? 3, 6, 9, 12, 15, 18, 20. 20 total candles. How many of them are red? Sorry, 21 candles. 1, 2, 3, 4, 5, 6. So 15 out of 21 candles are blue. Let's think about this mathematically, and this is why it's important that you understand this point, as I've always said. We don't just want to understand price action in terms of structure. We need to understand price action in terms of time, because how much time the market has been doing X or Y is communicative to us of where the order flow is more aligned. That communicates information about the order flow behind this move and leading up to this move. Notice I'm not talking about support or resistance or supply and demand zones at all. I'm talking about structure and time as pointing to what the order flow is behind this move. And so this is what we have. We have this situation. So 15 out of 21 candles. 60 hours of buying pressure out of how much? 84? Is that correct? 60, that's my mathematics. 60 out of 84 hours. So we're talking 3/4 of the total time for the last 84 hours has been buying pressure. And out of all of them, only one of them had a decent pushback. All the other pushbacks were just little slaps on the wrist. They weren't even a closed fist. It wasn't even a punch in the gut. We're just talking a little slap. Market responded to that saying, hey, you don't have enough force behind your hits. I'm going to keep hitting back. This is why it's important to understand that the live price action can be communicating something to you, that it doesn't matter what the previous support or resistance or supply and demand zones were. The live price action saying 3 out of every 4 candles or 60 out of 84 hours are buying. I don't have anything yet that should be telling me selling other than some previous history. But what good is past history in relationship to live history? Live, real time. History just offers us possible predictors for the future. Possible predictors for the future. But the bottom line is that right now in the market in real time, it's communicating to us we're still overwhelmingly long. The bias is still long. The order flow, which has created this recent price action, is still biased to the upside. So with that being said, he placed another buy order, 63.35, while still being long on his 62.60. He did take profit on his first lot on this, but he was still long from 62.60. He then put in another buy order, which would look like very precarious considering there was the potential resistance just above, and he said, I don't care. The live price action is communicating to me, and my systems are telling me, buy. So he bought. And where is the market now? As I zoom forward, it's above this. Broke through this with vigor. This is why I don't make the basis or the core ideology or the central point or the beginning point of my trading supply and demand zones or support and resistance zones. Why? Because the market can always, in real time, be communicating something to us that tells us right now history doesn't matter. History has less of importance right now than what's happening live in the market. Right now, the market is saying, I'm buying up 75% of every single candle that's out there. I've gained 350 pips. And of that time period that I've been gaining, only 24 out of 84 hours have I been able to sell off. And even when I did sell off, I was never able to fight back with much force. So to me, this supply and resistance zone or support and demand zone doesn't mean anything, or it means less. It has less weight. History right now doesn't mean as much. What matters is to me is what the market is communicating live in real time right now. So with that being said, that's why it's important, I think, and this is one of the things I'm trying to say is it's important to understand price action in real time because the market is communicating something in real time to you. The market can be communicating things in real time to you that are the most important things you could need to know about your trading. As I said several weeks ago, trading solely on supply and demand zones or support and resistance zones is kind of like you're sitting on the sideline and you're watching a train heading towards this cement wall, but the problem is that the cement wall, you just kind of know it's there, but you really don't know how thick it is. There's a giant curtain that's barely transparent that will tell you how thick that cement wall is. Now, if you know that the train is moving pretty fast and it's a pretty big train, well then you have to sit there and say, well, wait a minute, how thick is this wall? If I don't know how thick it is, then I don't have much information to go on in terms of that wall and whether I need to say the wall is going to stop the train. If the cement wall is 100 feet thick, I would probably feel pretty confident that that train is not going to make it all the way through. But what if it's 2 feet thick? Changes the game now, doesn't it? The train is still moving the same speed. But since you yourselves do not have access to order flow and cannot see how thick that wall is, you have to go with the information that you can see clearly, which is that we see this metal train flying along at the speed, and it's a big train. My guesses are it's probably going to make its way through that object based on the speed, acceleration, and size of it. It's far greater information than looking through a curtain and trying to see what's on the other side. Because that's what you're doing. When you're looking at price action, you are looking through a curtain and trying to see what's on the other side. You will never fully see the order flow on the other side of the market. And you know what? In some sense, it's kind of a shame. Because if you did, I would be willing to bet many of you would be much more profitable than you are now. And I would be willing to bet many of you who are barely profitable would be consistently profitable once you learned how to read the order flow. It wouldn't be that hard. Trading would be a lot easier. And I would be willing to bet that those of you who are already profitable would become more profitable. My guess is that more people would be making money than less people making money. So with that being said, we don't have access to that. So what we have to do is say, you know what? That information behind that curtain is important to us. Let's shine the brightest light on that curtain possible so we can see what's behind the curtain there. And I think out of all the tools out there, price action is the one thing that allows us to see most of what's behind that curtain. What kind of order flow is creating this price action? I think that especially, not just past price action, but the current live price action. What the most recent price action is. I think that communicates more information about order flow than anything else. And there are various techniques that you can use to kind of glean what's behind the curtain. Because the bottom line is this chart that you see is really just a curtain with just some information on it. It's never the complete picture. The complete picture is total aggregate and complete order flow in the entire market at the same time. If you had access to the entire interbank market, all the order flow that was out there, that would be the most complete picture you could possibly have. But we don't. So we have to figure out what's the best way to see behind that information that's on this curtain here, this chart. And so that's why I recommend price action as your starting point for doing that. Okay, so I'll take a look at some questions here, and then I want to wrap it up and make time for the next speaker. So, yes, I'm not going to tell you the system as to why he did that. That's for clients who pay for that information. So, good things are worth paying for. You know, and some people say, well, some of your stuff's expensive. It's true, maybe. Guess what? Losing money is more expensive. What is the system strategy? Boyke, the name of the system strategy is called my IBAR strategy, but that's not going to help you any bit of information because there's nothing out there on it. You won't find anything free out there. Manoj says, surely the fact that the resistance zone had already been retested made it less important. Why did it make it less important? It could. That's one perspective. But sometimes the more times something gets tested, depending on the nature of how it's tested, will tell you whether it's actually weaker or getting stronger. Sometimes there might be a wall that the more you push back up on it, the more you realize, I'm not getting past that. So it's the nature, the fact that it's been retested doesn't tell you that it's less important. It's how it got retested that communicates to you whether it's less or more important. And again, we keep coming back to live real-time price action. So I'm gonna disagree with you just a little bit on that point, Manoj. Biss says, there's nothing more dangerous than using a system where you aren't able to get the full info. Totally true. Totally true. I couldn't agree with you more. Genius FX says, if most just users stopped and flipped a coin, most would be profitable. Maybe. Nothing I'd want to put real money on. Rob says, so how do we determine the thickness of the wall order flow? You don't know how to determine the thickness of the wall. You can get some information. Again, you can make the curtain a little bit less transparent. And that would be looking at how many times did the market retest it before? What was the market's response to retesting those things? And what is the current price action right now as it's approaching that? That will give you some idea, but a lot less. It still won't give you the information you fully need to understand how thick that wall is. However, we can get more information. We can always glean more information about what is the most likely scenario that created what was the most likely scenario in terms of order flow behind this type of move. And once we can understand that, then we can understand whether we need to be long or short or out of the market. There are many different ways to do that. So that's my answer to your question there, Rob. Coca says, tell us, Chris, on that note, the more price spend at a level, the more or less strong it is at that level. Okay, I think I've answered that before. The time has some information, but again, we also need to look at the other side of the puzzle. Okay, there's no line in the sand. It spent 4 hours, 8 hours, 12 hours, 100 hours at a particular resistance level that will all of a sudden say, okay, this is a level that's going to hold or not. This is a strong level or a weak level. Time is not the only component to do that. What we have to look at is, some of the things you want to look at is, how many times has it retested it? Again, what did the market do when it tested it? Did it bounce back off it a little bit, or did it get rejected really heavily? Was the market able to close consistently near it, or was it only able to close very far away from it, and there were a lot of wicks rejecting off that level? When it rejected off that level, how far did it reject? How far did it go? What was the nature when it did reject off of it? What did the price action look like when it did that? Those are all very important pieces of information. And if you can answer those questions, then you probably can paint a picture as to how strong that level is. But then again, we still have to take a look at this right here, which is the most recent price action is communicating to us that regardless of how strong that level is, right now the price action is really, really strong. So that's my thoughts on that. So with that being said, first off, I want to thank you all very much for coming. Second of all, I also want to say, hey, please stay on for the next class. Why? Because Paul McDaddy, or McDaddy as he's known, is coming on. Mike Baghdadi, McDaddy, is coming on, and he is also a price action enthusiast. I actually will probably stay on for a little bit to hear what he has to say because I really value his perspective. I value his experience. I got to sit and meet with him at the FX Street ITC conference, and I think he has a unique perspective on the market, and I highly respect it. And so I hope you stay on for that because I hope you get to listen to it and learn from him. He has an immense amount of experience in this market, and I truly enjoy working with him, and he's just a really nice person to work with and a great colleague. So I hope you stay on for that. And so please stay on for the next class. Until then, I bid you all adieu. I wish you all good luck trading, and I will see you next week. Take care, everyone.